welcome back to another episode of Hoot and Poop. So in this week's video, right, I will be covering back to the learning series portion because I know, ever since November starts, when the Fed announces, the reduction in terms of the stimulus and stuff, the share price has been plummeting and then it's been dropping way crazier. So the reason, or rather the purpose for me to be here today is to explain to you, trying to break down to you in very simple terms what's all about, what's my plan, moving forward and stuff. Okay, so before I go on, let me just say a brief introduction of how my investing thesis is. So basically, I'm a long-term investor. I look at the fundamentals of the company. My investing horizons, it ranges from 3 to 5 years. So yes, the drop hurts me a lot, way a lot. Whatever gains I had throughout the whole 1 year has been wiped off to the red now. Okay, but am I fearful? Not really. I'm not really fearful. Am I buying more? Yes. But I will explain to you what's it's all about in my own definition. So I hope that you guys can appreciate. You guys can give me an early like and subscribe to my channel. All right. So without further ado, let's go. Okay. So in today's learning series, I want to talk about this thing called the interest rates, because basically this is in very layman term, right? This is what causes so much changes to the stock market in some ways. Okay, so in CNBC's news, right, they published last Friday, they mentioned that the Fed is speeding up the end of bond buying. Okay, so because of this bond buying, right, the ending of this bond buying, right, the Fed is no longer printing money, okay, and also signaling an interest rate hikes. Okay, so this is official news, right? It's not going to change. Okay, so basically this is a bank. Okay, when a bank raises, right, the interest rates, okay, what happens is that generally people will tend to reduce in terms of their borrowing of money. Therefore, right, the availability of money in the market, okay, will reduce in some ways. Okay, so this is generally how it's all about in a very simpler term. Okay, so basically that's why you look at this part. Okay, so they say that because of the Fed decided to taper its bond purchase to reduce the printing money. So in terms of the cash outside, it's lesser. And also rise of interest rate means to say the borrowing, it's not that easy anymore. It's no longer like 0% or 0 point something percent to borrow it. It's you borrow money, right? You have a high interest rate, so therefore this affects the flow of money in the market. Okay, so in some sense, what I'm trying to say is that, right, in terms of the availability of market money is no longer that easy in the market anymore. And because of that, right, investors tend to not to buy, be so aggressive in terms of buying shares. So you can see, CrowdStrike, they plunged so much down from a high of about 300 to 200, $100 plunge. You wiped out how many months worth of growth. Upstart, right, from a high of 400 plunges all the way down to 160, $150. It's really crazy. Look at C Limited, right? It plunges down to about 230, 215, around this range. So this is the impact, right, of this whole news. Okay. Now, before we all jump into the whole crazy mode or frantic mode, right? Basically, there are two trains of thought that can come about when every time the price drops. So when the price drops, right, the first school of thought is that good, I can buy more. Okay. The second school of thought is that, oh man, all my gains are wiped out, etc. and so on. These are really common thoughts that that haunts you on a day-to-day basis, including myself. So moving on, I do not know when the price will drop. It may potentially break 200. It may potentially drop to 150. I don't know. Likewise, when the price is at all-time high of 380 or whatsoever, I don't know whether we break 400. I won't know. Nobody will know. Right? If I know, I would have just sold everything here and then just wait for the plunge, right? So nobody would know. So what's moving forward, these are my 3 guiding principles that will be helping me. The first portion is that I am a long-term investor. So meaning to say, okay, my investing horizons is really, really long. Because take note of this first criteria. All right. So in terms of the 3 principles, I want to talk a little bit more about what this whole thing all about. The first thing is that time my entry with my cash balance. So because I'm someone that don't hold a lot of cash in terms of my investing portfolio, basically, I'm probably left with about 10-ish percent in terms of cash. So I can't keep buying on a day-to-day basis or week-to-week basis. Sooner or later, one day my cash will just drain out, right? So what I'm going to do is that basically based on my last calculation, I have about 15% of cash left. Okay, so this 15% of cash, I basically time myself on a weekly basis to enter about maximum of 2% each. So basically, this whole 15% of cash will probably last me for the next 2 months. So meaning to say, from December, it will last me all the way until the end of January. So end of January is probably the time where I will be going all in. So this is my plan for the next 2 months. Okay. Of course, when I say whatever cash balance I have and so on, please take note that these cash are cash that I don't need for the next 3 to 5 years. Right? I basically have already catered about 6 to 7 months worth of cash in my own liquidity of cash. All right. So basically, I do not need this cash that I'm going to be investing in. Okay. So the only time I potentially may need it is about 3 to 5 years later. Okay, so that's the first criteria to time my entry. This is not a time to be hero to say, okay, let's go, let's bet big. No, this is not the time. Now, when I say that, right, I don't mean, it's not the time to be buying. It's not. But the point is that we are all humans. We all need psychological so-called comfort. Imagine if you keep buying, or rather imagine if you dump all in now and the price starts to keep dropping for the next 2 to 3 weeks. If you are okay for it to happen, so be it. But most people are not. I'm not, I admit, I'm not okay. So what I do is that I time my entry. I don't like to miss out, all right, when the price drop. At the same time, I don't like to be hurting so badly. So that's the first one. Okay. Now, second, recheck my valuation. So before that, my valuations may be somewhat bullish or whatsoever, but because of the rise of interest rates, all right, the valuations are at the exit multiples that investor gave will definitely have a detrimental effect, will definitely take plunge. So I will recheck my valuations, perhaps by introducing more stringent so-called more stringent risk-free rate or margin of safety, okay, so that I know what is my entry level. Now, this part here, I really want to say is that, number one, I don't mean to say that if whatever prices that I bought before this rechecking exercise, like if the prices I bought, if it's too higher than my rechecking exercise, doesn't mean I sell. No, I am not selling. Okay. The point I'm doing this revaluation of all this valuation is because I want to time my entry with my cash balance. That's simple as that. So it's not here to say, oh, I want to sell, or because overvalue or whatsoever. No, it's not. Like I said, my investing portfolio is 3 to 5 years time. And whenever I look at companies, right, I'll always make sure that the company must be growing. So if the company is growing, and if they are still growing 3 to 5 years time, most of the time, 99% of the time, the share price will do well. All right. So this rechecking valuations, all right, is for me to time my entry based on the price. All right. And the third part is that if you are no more cashed, or if you have already maximizes your quota in terms of entering the shares, all right, the market, then just enjoy life, right? Come on. Your life is not just about stock market, right? It's the same as your life is not just about your work. You know, your life is not just about your career whatsoever. You have your own life. You have your life with your family, your life with your friends, even having life with yourself. Read a book, go out, exercise, take a walk, just enjoy it. What's the point of having so much money, okay, and you are not enjoying your life? You might as well just die off without money and be happy with it, right? I mean, this is something very more extreme. So my point here is that as long as your investing thesis is a long-term one, okay, that's for me, all right, and you're touching money that you don't need at all, and you're comfortable with it, so be it. If the company you have are really good companies, they are growing, go ahead, so be it. You know, when I say growing, right, I want to just clarify this misconception that people may have. When I say growing, I don't necessarily mean growing in terms of financials. A lot of times growth, okay, it's not just based on financials, it's also based on the fundamentals. For example, ClearPoint, I talk about it. They sign more partners, you know, they sign more, they have more research partners from 35 to 40 or something like that. They sign more collaborations with medicals like Adior, like Philip, like Mastro. Now, doesn't mean that all these collaborations, even though in short term it doesn't give any financial impact to it, doesn't mean that these are not growth factors. No, it's not, right? They are growing, right? You should talk about Arkit. You know, Arkit collab with this, collab with that, collab with Neon. You know, collabing rather UK uses them. Now, even if UK uses them and so on, even if they don't pay them, you know, even if there's no financial impact in the short run, doesn't mean that they're not growing? No, right? And you think about it, for Arkit, if they launched in 2023, they launched the two satellites up, what kind of revenue we're talking about? None, right? They have to spend money, right? So then the question is that, are you trying to say that Arkit is not growing? It's not, correct? So the point here is that when we talk about growth, it's not just financial growth. Of course, financial growth are important, but you have to understand the company's fundamental to see what kind of growth you're talking about. All right. So basically, this is okay. So I mean, talk about growth. Let me just give you a very simple analogy. You talk about this person. If he just eats chocolates every single day, okay, in 1 month's time, his weight may not even gain at all. But doesn't mean that, you know, his health is not deteriorating. No, right? His health is deteriorating based on his action. So this, if this simple logic and allows you to understand in terms of growth are not just, you know, based on numbers. It's the same for companies that we are investing in. It's not just numbers. So it's a bit off topic based on what the three guiding principle is, but I just want you to understand that, you know, how do I look at growth? It's not pure numbers. Okay, so these are my three guiding principles, especially the last one. Enjoy life is something that's really important. Okay, regardless whether you are just starting out, you know, you've been investing for so long, it doesn't matter. What matters most is how you enjoy your life. All right, so with that, I've come to the end of this video. I really appreciate it. Like and subscribe to it, and I'll see you in my next video. Invest safe.